Episode 571, Trading Justice Podcast. My brother Matt, myself Mark, coming at you, Justice Brothers. I'm going to talk some Fed. My brother is going to conduct an interview with Guy Cohen. I'm going to ask Matt a little bit about that here in a second. But before we get going on hammering on the Fed, asking questions about what happened this week in this fantastic interview, help us out, like, promote. We give our heart, we give our soul. Help us out, share the good word, like, share, spread the word of the Trading Justice Podcast and Tackle Trading. It helps us out immensely. You know what also helps me, Matt? Drinking games during Jay Powell press conferences.
That recommended, not officially recommended by other Tackle Trading or Trading Justice, but
absolutely recommended by me. Matt, how are you doing today?
Doing good. Excited to be here with the, I'm just excited to be here to give an update on the pod, but regarding monetary environment, but really enjoyed the Guy Cohen interview as well. I hope our community enjoys Guy, can learn from Guy. Guy's been he's been a friend of the podcast, a friend of Tackle Trading. I've known him for about 15 years. And, the one thing about Guy is he's the same guy he was 15 years ago. He's the same dude today. And I love that about people like him that have had a tremendous amount of success in the world, from a investor's perspective, from a trader's perspective. But he's the same guy I met 15 years ago, and that's what I'll always love about him. But I also love the fact that how he puts into advanced concepts, and I've said this many times, and it's one of the biggest compliments I can give somebody like Guy, is to take the challenging thing as an educator is taking complex material and making it simple and digestible for everyday human beings that are not born and raised in the financial industry, or was born with a silver spoon in their mouth. Taking complex situations, macro conversations, and really simplifying that approach for people is a skill set that he certainly possesses. And we had a conversation on the big money footprints, and I just love how, similar to how we at Tackle, discuss certain fundamental or technical conversations, but how he goes about it through the 6 big money footprints is really enlightening. And so I hope people certainly learn from that conversation and enjoy the conversation. If you love the conversation, obviously the best way to support the podcast is like and share on YouTube if you're watching it on YouTube, or certainly tell a friend about it, or a nice little 5-star review on iTunes always goes a very long way. But with that said, looking forward to the pod today.
I mean, some of the best compliments I can get as an organization we have is somebody will send me messages like, hey, one of your members, one of your listeners told me about this, and wow, great job. I mean, it's just such a good feeling. So help us have those warm, fuzzy feelings. Matt, I didn't have any warm, fuzzy feelings on Wednesday at all. Let me break down, first of all, a Fed day. There's 3 things to look for on a Fed day. Now, sometimes there's only 2, but right off the bat, you have an initial policy statement. And in this initial policy statement, it's oftentimes very similar to the language from a previous policy statement. And so people are looking for changes in language. We didn't have a lot of change in language in this statement. On some of the projections, they projected GDP to be a little bit higher moving forward throughout the rest of the year. So they see the economy doing a little bit better. Unemployment was about where they saw it the last time we heard from them in an official capacity. Inflation, they also, by their own numbers, have inflation, core PCE, a little bit higher, a little bit higher. They also, on their dot plot, not every Fed meeting has a dot plot. And if you don't know what a dot plot is, you're probably no worse for the wear. But officially, it is a projection of how many cuts they see coming down the road. And that dot plot previously had shown 3 cuts. This new one showed 3 cuts. And they further out years about a little bit difference, but within about the same different ballpark. And so, Matt, at 2 p.m. Eastern on Wednesday, we get this. And higher growth, higher inflation, still cutting 3. What was your initial reaction on the initial release of the policy statement on Wednesday?
Well, on the release of the policy statement, I wasn't surprised in any capacity from the actual policy statement. There was not really an expectation that the Fed was going to change anything from a policy perspective. They came in at 5.25. That's where they were expected to come in at. And so that was well known going into the event. This was always going to be, this is one of the meetings. You get 4 every single year, 8 total meetings, 4 of this nature, where you get both the policy update, you get a SEP update, the economic projections update, and then you get the dot plot update. And so everything around the interpretation of this meeting is around the context of some of their updates from an economic projection perspective, an inflationary perspective, and an overall interest rate perspective. And I think that's where, the debate really starts, is not exactly what's transpiring today, but what does the Fed messaging mean for the future? And we'll get into that very quickly here in just one second. But from a policy perspective, not a lot of shock and awe there. From a forecast inflationary perspective, I think with the bumps up in both CPI and PPI over the course of the last 2 to 3 months, you had to reflect that in your SEP. You had to reflect that in your policy statement. And that's what you did see in the official projections. Core PCE goes up to 2.6% from the expectation of 2.4%. And so that's obviously one of the concerning data points, is that in the Fed's own projections, using PCE core language, that is the Fed's preferred inflationary measure, that's got to be a little bit concerning. And then the GDP forecast also had a sizable increase. So the only real sizable change from where we were in December of 23 to today, December of 23 was the last time we had the SEP and the dot plot, is basically you had an upgrade in core PC inflation to reflect the last 3 months of bumped up inflation. And then you had the GDP forecast go from 1.4% up to a pretty impressive 2.1%, which is the best number from a projection perspective, not from a total GDP. That was the third quarter last year, but 2.1% from a projection perspective in the SEP is the biggest number we've had in the last few years. So from macro perspective, 64,000 feet in the air, inflation is sticky and still concerning. Labor market is going to be sticky right around 4% for the next couple of years, it looks like, in the Fed projections. And overall, it does look like the U.S. economy is on a path to a recovery. It looks like inflation is sticky around the 3% number. And regarding the Fed's internal fortitude of how they're going to handle this challenging condition, I think that's open to debate.
Yeah, I know. And so there wasn't, I found, I actually did some bullish plays the second I saw that they had not dropped the dot plot from 3 cuts to 2 cuts, because there was some speculation that, they might scale back the amount of rate cuts they anticipate. That didn't occur. And so there wasn't any hawkish, bearish surprise. There wasn't any surprise here, right? It's like, little stickier inflation. Well, we're just seeing the data, stronger growth. Go ahead.
I think that is the surprise, though, is that fact that the dot plot did not adjust to the bumps up in inflation. Again, in the policy statement, if you just take into account 2 things, okay? GDP forecast goes up from 1.4% to 2.1% for this year. Core PCE forecast goes from 2.4 to 2.6% this year. If that's all from everything in the policy statement is those 2 numbers, then the shocking part of the statement is the dot plot does not change to reflect both the economic improvement as well as the inflationary concern. Because if you have GDP go from 1.4 to 2.1%, and you couple that with the core PC report going from 2.4 to 2.6%, isn't the easiest argument in the world for the Fed to be like, well, we have more economic growth to play with here, which means we can be even more vigilant against inflation. And that was the opposite of what we actually saw Jay Powell talk about.
Well, yeah.
So I guess for me, I guess to answer the question though, is there was a surprise, and the surprise was on the raw numbers coming in at 2.4% on, or excuse me, 2.1% on GDP and 2.6% on core PCE, which were both well above the forecasted numbers. That's the takeaway, that the dot plot did not adjust to the inflationary situation and the economic growth situation.
And so just by these takeaways, just by what the Fed gave us, right? Inflation, expect a little hotter, growth a little bit higher. Any objective human being would say, all right, let's let this play out. Classic, let's see how the data comes. If the inflation does continue to be hot, then we won't be able to cut. That would just be a stem. All other things being equal, which they obviously are not from what we saw by Jay Powell, but we'll get into that in a second.
Jay Powell, he did reassert his commitment to bringing inflation down to 2%, and he did reassert his commitment to being data dependent. The problem with the words he's using is his actions lead to a different conclusion. And that's the problem. For example, we're committed to 2% inflation, but the economy is going to grow hotter and inflation is going to go higher. Okay, then how can you square those two data points?
Man, I am committed to healthy living as I drink Coke and eat chocolate donuts and do. I can say I'm committed to healthy living all I want.
I guess you can parse the numbers however you want. Again, even Powell will agree that it is up to interpretation. I don't know how you square your commitment to a 2% inflationary target while on the same hand also updating your economic forecast, updating your inflationary forecast, as well as around the edges, also loosening the monetary conditions, as well as ending quantitative tightening. Those things don't go to the commitment to a 2% in the face of the economic and the inflationary numbers that we did see coming out of Powell on Wednesday.
Yeah, let's get deeper into what Powell said on Wednesday, because this is what the story really is. Now, Powell spent a good chunk of the press conference talking about inflation, right? Mm-hmm. Reporter after reporter after reporter would throw different questions on inflation from a different angle. And he acknowledged, he acknowledged, because that's what the facts said, that the January number was high. Very dismissive of this, though. He was like, there could be seasonal effects there. I don't remember Powell ever talking about that with regards to inflation, but it fits someone who would want to dismiss it. Said the February number was high, but not terribly high. His tone, Matt, and there's no way to really quantify this, but everybody saw the same thing. Somebody that certainly was not hammering down we need to be objective, right?
No, I think honestly, it for me, it's as simple as this. We were told to be data dependent for months and months and months and months. We were told,
Matt, for years. We've heard that for years.
Yes. And just to kind of go on the quote that you were talking about, this is exactly what Powell said on inflation in the press conference. I would say, quote, I would say the January number, which was very high, the January CPI PCE numbers were quite high. There's reason to think that there could be a seasonal effect here. A little bit of my own commentary there. Please expand those seasonal effects in the first quarter from an inflationary perspective. But nonetheless, we don't want to be completely dismissive of it. You kind of are. The February number was higher than expectations, but we have it currently well below 30 basis points core PCE. No, it's not, which is not terribly high. So it's not like the January number, but I take the two of them together and I think they really haven't changed the overall story, which is that inflation is moving down gradually on a sometimes bumpy road towards 2%. I don't think the story has changed. And this is where I fundamentally disagree with Jay Powell. This is where I have concern, because I do believe the story has changed. And he, for one reason or another, does not, despite acknowledging the numbers have improved from a GDP perspective, the numbers have gotten worse from an inflationary perspective. He acknowledges those, he dismisses them, and that's where I think the story has changed. You can tell me that he's committed to a 2% target. He says it all the time, but the simple reality is when you look at the inflationary pressures over the last 2 to 3 months, the story has undeniably changed when you take into account the bumps up in inflation, the current breakout and momentum trends that are happening in gasoline, oil, gold, silver, commodities across the board. Quite frankly, that has to be taken into effect as well. And so for me, this is just simply where I disagree with Jay Powell, in the sense where he says nothing has really changed the overall story. And what he's talking about is the path to 2%. And I will be the first to admit 3 months ago, 2 months ago, I was willing to give Powell a little bit of latitude here to kind of maneuver, given the fact that you were, in general, on that path to 2%.
Yeah, you did not get concerned, and you didn't get on this kind of like soapbox until the numbers started changing. And when the numbers started changing, you're like, all right.
It's not just the numbers. The numbers reflect just what's going on in the market today. It's the things that are happening right now from a loosening of financial conditions when you should be vigilant based on this. That's where the mistake is being made here. It's not discounting the bump up from December to January, or it's not necessarily discounting the bump up from February to March. I agree with Powell that in the long-term, battle down to 2%, you're going to have ebb and flow in that. Absolutely. There's going to be bumps up over time. But Mark, we are now 7 months of consolidating inflation north of 3%. 3% was always going to be an extremely sticky number. And in the back of my mind, I believe there's a soft inflationary target between 2.5 and 3%. And so with that said, I think the data has changed. And I think the loosening of financial conditions is really hurting our ability to finally achieve that 2% target. The annual CPI number over the last few months has went from 3.1% to 3.4 to 3.1 to 3.2%. That's extremely sticky inflation. When you look at the PPI number, pipeline inflation has been a really strong argument for Jay Powell being committed on this monetary path. But Mark, from December to today, that PPI report has doubled in expectation. And you might just say, well, Matt, it's under 2% still. That's fine. These things can get out of hand very quickly if you're not vigilant. And when you go from 0.8 to 1.1 to 1% over a 2-3 month period, okay, you can discount that a little bit. But when you see the constant bump up in PPI expectation, that's going to have a trickle-down impact on the CPI report, which will therefore have an expansive impact on the consumer. And so I have concern over the last 2 to 3 months of inflation. I have more concern than what Jay Powell is leading into that concern. And so when you take it into the condition we're going through, yes, I think if you're focusing on the last year of the inflationary battle, I think you can give Powell and the cronies at the Fed a little bit of credit for being vigilant on their inflationary battle. I don't think you can make that argument in the last 2 months, quite frankly. And as that data changes, I'm certainly going to change with it. And Mark, if you'll remember, I wasn't very critical of Jay Powell and the Fed during their inflationary battle. I understand it's going to take some time. I understand these things are going to have an impact. But when there are mistakes being made in real time, and that's going to have an impact down the road, and you know it's going to have an impact down the road, I think we have a responsibility to call that out. And so when you're looking at Powell and his ability to get to the 2% target, I'm just openly questioning whether or not their commitment from an actual application perspective is meeting their commitment that they like to tell everybody about. When Powell was asked a question regarding
and let me talk about this, because I'll be even more blunt. I don't think they have any commitment bringing this down to 2%. The Powell I saw on Wednesday was a political operative there to deliver a message that, hey, inflation's going to come down. Don't worry about it. We got this under control. It was a political message. Now, one can speculate, and we don't have time today to go into it all on why he is doing that. But it was just so clear. The clearest point was on financial conditions. Financial conditions are incredibly loose right now.
They're as loose as they were before they ended the transitory conversation. And that is a factual statement.
That is a factual statement. And one might ask the question out loud, well, if we have really loose financial conditions, when inflation is starting to show some stickiness and even some acceleration, won't this provide a really potentially powerful problem? A reporter, one might ask that question, and guess what? A reporter asked that question. You should have saw Jay Powell's face turn cranky immediately, and then he totally gaslit the entire financial community and American public. Ignored the reporter's question entirely, dismissed it, did not acknowledge it, and then had the audacity to say, yes, we think financial conditions are weighing on the economy, as if the reporter had just asked, are financial conditions weighing on the economy? Which was the exact opposite of what she asked. And he's like, yes, they are. They're weighing on the economy. Total gaslighting. Perfect example of gaslighting.
The data is extremely straightforward and compelling. Financial conditions are as easy right now as they were before the transitory language was killed. And I'd like to ask Powell, what type of participant in our economy is those financial conditions weighing on? Because to me, it seems like he's speaking out of both sides of his mouth here. Are financial conditions tight on the vast majority of American people?
Yes, they are.
That is yes. It absolutely.
Me, on your average 100%. Person, 100%.
90% of the American individual, they are extremely tight. But what about on the banks? What about on the corporations? What about on the impacts on the financial conditions on Wall Street? They're extremely loose right now. They have, and so he's speaking out of both sides of his mouth in the sense of speaking to the American consumer, saying, yeah, the 22% net interest rates on your credit cards, that's really tight. 7.5% on a mortgage, that's really tight. But what about, to Bank of America, Wells Fargo, JP Morgan, Citibank, Barclays, Deutsche Bank? Let's throw in the international banking conglomerates there as well. And so there's two economies here, and that's a problem.
And Matt, if he had any argument against that, he would have said that when the reporter said that. But no, because he knows everything you just said and doesn't want to talk about it, he turned the question on his head and completely ignored it.
Then if this statement of financial conditions is blatantly false, which it is, blatantly false, and he knows that.
You should have saw his face. It's so
why should we trust him on
anything else? You shouldn't.
Not openly just say, yeah, financial conditions are a little bit loose. They surprised us with how far the market is. You could easily discount that one and put the blame.
Because Matt, this is not a dumb, unprepared man.
No.
He knew that a potential question would come up. You could have had a response ready. And yet he chose, his response was
he knew
dismissive.
This question on financial conditions was going to happen. Everybody was talking about it going into the policy statement, and the best he could prepare for was a
gaslighting.
question, gaslighting, and a quote, we think financial conditions are weighing on the economy. No.
Wow.
Weighing on American consumers, and you know it, and you didn't want to say anything other than that. It is one economy for they and another economy for us, and that is
your Federal Reserve.
Impact on a lot of things, not necessarily just due to inflation. But with that said, Mark, the last thought I have here today on this conversation, and then we'll get into the Guy Cohen interview. And sorry, Guy, for being a little bit aggressive going into your interview here, but inflation. It's a fascinating topic, and something Mark and myself have a lot of respect for as well. J. Powell said this: we are strongly committed to bringing inflation down to our 2% goal over time. That is our goal, and we will achieve that. Markets believe we'll achieve that, and they should believe that, because that's what will happen over time. That is powerful projection framing. It is. Mm-hmm. It is powerful projection. It's powerful framing. And I'm openly questioning your commitment, J. Powell, to achieving a 2% target over time. And I also would like you to actually define what overtime means, because before Wednesday, that overtime meant by the end of 25. Now we're talking by the end of 26, 27. And so I want to understand exactly what that commitment is. To me, Mark, we talked about this last week, and I'm not going to go through it in detail this week. Check that podcast out from last week. But for me, having an understanding of where we're at in this inflationary battle in regards to historical inflationary battles is extremely important. Last week, I made the statement that we're in the recovery process, but we're at a very, very important level where you need to be vigilant against inflation. You need to double tap inflation. You need to make sure inflation is completely gone before you start taking your foot off the gas. And at the end of the day, Mark, and again, Powell.
And listen, if you want more context on what Matt, this was a great podcast last week. If you want more, go listen to it. Matt did a fantastic job breaking down this argument in detail.
Powell is right that a lot of this conversation is a matter of how you are interpreting the data coming in. And that's fine. We can agree to disagree on the interpretation of data and its meaning on a month-over-month perspective. But to me, this conversation is extremely important in the sense that you're on a path to recovery here. You are. From 10% year over year inflation down to 3%. You're on that path to recovery. But it's not there yet. And you got to be vigilant about that. I made the statement last week when I was dialing in the 1972 to 1982 decade saga of double dip inflation, that where we're at right now in the first battle against inflation is in that 1976, 1977 level, where you were on the path to achieving it wasn't 2% back then. That target got changed. It was 4%. It was like 3 to 4% back then. But before the inflation started going up, it was right around 3.3%. In 1976, you were right there, right around 5.8%. You were on the path. It was on a good path. You were on the path. But you also started seeing commodities break out and run. You started seeing the economy pick up a little bit, creating some economic stagflation. And the central bank took their foot off the gas pedal. And by taking their foot off the gas pedal and loosening up financial restrictions, that fostered in an environment for a double dip inflationary situation that made the first dose of inflation that we went through from 72 to 73, 74 feel like a walk in the park in comparison to what occurred in 1978, 1979, 1980, going into 1981. And when you're looking at that inflationary battle, once again, there are two moments in time, not in recent history, but there's two moments in time, very importantly, where you had one central bank handle it differently than another central bank did. And in 1976, when the central bank took their foot off the gas pedal and allowed inflation to creep around, without giving it the double tap treatment that you absolutely need to treat inflation with. I've compared it to the evil villain in a horror movie. You got to make sure it's gone. Well, they didn't do that in 1976, 1977 then, and that's why Paul Volcker had to do what he did in 1981, 1982, and 1983. Remember, in 1974 to 1976, you're on the path to inflationary reduction. You ease off the gas pedal, and inflation comes back around. In 1981, 82, you're on that same path. Volcker's committed to it at this point. Volcker comes in late 78, 79. Volcker's committed to it. And at that exact same level that they were faced with in 76, Volcker stepped on the gas pedal and said, we are going to deal with a little bit of economic pain to cure the inflationary situation. Well, what is our central bank? You take this conversation, you overlay it on today. Where are we at today? Right now, today, we're in the exact same moment of 1981, 1982. We're on the path to inflation reduction, the same path we were on from 1974 to 1975 to eliminate inflation. And yet two different responses made history from an economic perspective in U.S. history. The 1976 to 1977, taking your foot off the gas pedal and letting inflation reemerge was a death sentence from a economic system perspective, from a political perspective. It fostered in an entirely new economic philosophy in the 1980s. You had an entirely new political philosophy embraced in the 1980s, because this is what these conversations do. They change the DNA of the American culture. And we have to be committed to ensuring that we do achieve that 2% inflationary target. In 1982, Powell was, not Powell, but Volcker was vigilant. Powell right now is repeating the 1976 mistake of saying they're going to be vigilant against inflation while allowing the back door to be open to loose financial conditions, and it will kill his battle against inflation. And so, yes, I agree with Powell that the last 2 months we can debate. I don't think it's debatable from a historical perspective, the mistake that the Fed is currently making. And they can easily go back to the 1970s. Powell has mentioned the 1970s many times as a comparison to what we're going through now. Well, if that is the comparison, then it is time to be Paul Volcker and be vigilant. And that's where the disagreement comes into play. It's not necessarily on the overall path here. It's the changes in philosophy that we're seeing in front of our very eyes with the loosening of financial conditions, the elimination of quantitative tightening, the embracing of certain quantitative easing, and all of these things are loosening the financial restrictions to the point where the only entity in America that is actually dealing with the inflation is the consumer, and that is wrong. And so, yeah, I think the data strongly suggest be vigilant against inflation. And I think the data strongly suggests that if the Fed does not reverse the mistake of opening up the back door to loose financial conditions, it's going to eliminate all the progress that they have made in the last year and a half. That's the mistake I think the Fed is making right now.
Yeah, heck, I would vigilant against inflation. I would take as a win someone that at least appeared to be objective in analyzing the data right now. But
whether or not he's being objective or not, I'm not sure. I think he's cherry picking data points to support his argument, and I think that's easy to call out right now.
Yeah, and I don't want it to be, I don't want a college debater cherry picking data to be in charge of the biggest central bank in the world. So,
well,
but
we'll see what the end result here is. But all I heard every second Powell was talking on Wednesday was buy gold.
Yeah, and I think a lot of people heard the same thing.
Yep.
Well, listen, obviously we are going to continue to talk about Powell analysis, how it impacts your investments, what you should do to protect your future. I mean, these are going to be constant themes under this backdrop. And over the last few weeks, Matt, we've talked about quantitative easing, things the Feds have been doing in the last month. We've talked about inflation and gaslighting. We've talked about the Fed. The last few weeks have been setting the stage. Lots been going on. The Fed's telegraphing what they're going to do. We have to respond as individuals, investors to this. But yeah, I think gold ownership's not a terrible idea. Right. Any thoughts, Matt, before we head into Guy?
No, hopefully everybody enjoys the interview with Guy as much as I did having the conversation with him. So hopefully you guys enjoy the interview. And if you need anything from us at the Trading Justice Podcast, obviously sponsored by our amazing sponsorship at Tackle Trading. You can always go over there to tackletrading.com, sign up for a free trial membership, and check out all the goodies that pro members enjoy of tackletrading.com, an amazing community of like-minded investors helping each other navigate the financial world together. If that interests you, come check us out. Welcome back to the podcast. And today we are absolutely thrilled to have the amazing trader, educator, author, creator of software, just the absolutely extraordinary Guy Cohen back to the podcast, friend of the podcast. You know, Guy, well, I'll let you talk about a little bit about your intro, but just an amazing author of just amazing trading books, such as the Bible of Option Strategies, The Insider's Edge. You also wrote one of the first books I ever read was Options Made Easy, Guy. Long before I ever met you, I read that book. And you know, one of the things I loved about that book and what stood out to me was I read your book, Options Made Easy. I also read Lawrence McMillan's book on options. And I just, when I read Lawrence McMillan's book, great book. I don't want to say anything bad about it, but I also didn't understand a lot of what he said. The beautiful thing about your book and what I've loved about you throughout your career before and after I got to know you was you just love to make things simple for traders. And that's what I love about you. Guy, it's a pleasure to have you on the podcast. How you doing today, my friend?
Thank you. Lovely introduction, by the way. Very well. Thank you very much. In fact, you know, some people who know me more privately, they go, okay, Guy, tell me, who wrote your books? I go, I did every single word, and I'm a control freak too. So every syllable, every word. But yeah, it's look, it's important not to trivialize things, and so you have to have the good stuff behind everything. But you can obviously simplify things. The way I did it with options, by the way, is to make everything into pictures, and that's the way we do it with the software as well. So if you're visual, then you'll do well with us.
You know, honestly, Guy, from the minute I read your book, I knew you wrote it because you wrote it to normal people so that normal people could understand it. And I just felt it was such a good read, such an easy read, but a very, very important read. And obviously I could say the same thing about a lot of your work, but I want to kind of get into your journey here, Guy. Everybody's got a starting point to their journey in the financial world where none of us are born into it, right? We get our toe in it, and then we start just forcing our way into it. Guy, how did you get your start in the financial world?
Well, I can start with a good sob story, actually. So I was making my way in the real estate world, and I wanted to combine that with financial because I was aware of people close to me not being financially literate. And also I knew in the real estate world, a lot of people are very creative, but they're not, again, financially literate. So I thought I need to be able to do this. So the idea was to combine the two things together. But in my very early 20s, I got this very nasty gastrointestinal illness. And long story short, I ended up doing an MBA, but a finance MBA. So it wasn't marketing. It was like a finance MSc. And having just conquered that illness through extraordinary methods, I wrote a book about that too, by the way. Then what happened was I joined the most difficult electives. I felt that I was, I could conquer anything, so I might as well go for the most difficult things. And everyone was terrified of the options elective, so I was drawn to that. And just to sort of expand on that story, we had two options lecturers. One was, a proper academic professor, nerdy type, and the other one was a visiting professor who'd made millions across, various investment banks. But in separate lectures, they both said, if you want to beat the stock market, figure out what the options traders are doing. And it was kind of, we're talking about the 1990s then. So
Yeah.
data was very patchy. It wasn't like it was today. Computer power wasn't like it was today. And so they were kind of tongue in cheek, but there was a seriousness to it as well. And that began a whole new sort of thrust in my career, focusing on options data, and took it from there. So from the
Can I
sort of
ask you
mid
a
to late
question on that
1990s.
very quickly?
Yeah, go for it.
Your early experience, you had two lecturers. One was more analytical, definitional based, I'm certain, kind of textbook driven.
Yeah.
The other one more action, real life experience, talking about.
That's right.
What was your desire to get into the markets following the first lecture with what I would call a traditional professor versus the visiting professor with actual, feet on the ground experience?
Well, it's funny with the nerdy one. He was Gordon, really nice guy.
Yeah.
There wasn't much inspiration there, obviously, apart from the knowledge piece of it. Obviously, the other guy who was Kevin, he was an inspiration because this was a normal guy. This was not, someone of privilege. This is someone who'd worked his way through the back offices and in the city of London and then in Wall Street. He was I wouldn't say a barrow boy, but he was, good. He was made good, as it were.
Mm-hmm.
And so that was the real inspiration there. But just a few years later, when I built my options software, which is, is highly visual, the way it works, which is why people like it. I showed it to the nerdy one, the first bits of it. He goes, "No one needs that. We've all seen it before." I go, "But not like this." And see, from a nerdy professor point of view, an academic professor, they may understand things very quickly. But for the normal people like you and me, and we are normal people, we just try hard. It's not that easy. It's not that intuitive, and you've got to make it intuitive. And this is how I taught myself. I translated the entire syllabus for the examinations into pictures, and that's how I got a good mark in that module. Otherwise, I'd have been left stranded.
Well, it's amazing when you think about it from an education perspective. You have this professor that more analytical driven, numbers driven, textbook driven, those types of things. They don't understand the creative mindset. And
No,
most people, in my experience, and I, much like you, Guy, I've traveled the world teaching people how to trade, and you deal with a lot of different mindsets, and you deal with a lot of different people, and you got the analytical people and you got the creative people. But what I have found, the analytical people like to learn through numbers and data and analysis. The creative people like to learn through analogies and stories and pictures. What I have found is even some of the hardest stated analytical people actually retain and learn more when you have a visual imprint on that as well. And one of the things that I've found absolutely amazing about your journey, Guy, in getting to know your story over the years, is you have the ability to take the difficult, take the advanced, take the damn near impossible to understand, and simply by showing it through a visual, you have an ability to kind of break through some of that ice that other people just simply don't have the ability to do. Can you speak?
Yeah, no, that's very kind. And I have a foot in both camps. I am kind of half and half, if you like. And actually, we had some fun the other day when we talked about something that's that most people find incredibly difficult to get, but then when they see what I showed you the other day, it was like. Mm-hmm. It was like lots of aha moments happening at once, and even you were like, you understand these things anyway, but you like go, wow, that'd be great to communicate with people.
I just love the visuals of how it describes, like when you're talking about buying a call option, you're talking about it from an analytical perspective. It's one thing, but then when you just show a picture of how a risk graph works, people have a tendency to understand it a little bit more.
Absolutely.
And that's something I do think you excel in there, Guy. I want to talk a little bit about your trading philosophy here, Guy. Obviously, you got your start a little bit from a traditional perspective in the financial world. Early on, how did you go about your first trading? How did you go about your first investing? And then let's shift into kind of where you're at today from an overall trading and investing philosophy.
Well, yeah, I started very early in that I was always fascinated with that whole world. And my first trade was in a company called Wembley PLC on the London Stock Exchange.
Okay.
And this was the strength of my analysis at the time. It was a big stadium, took 100,000 people, and my analysis went along the lines of what could possibly go wrong there. And that was it.
Very famous. Yeah.
Yeah, and I actually can't remember what happened. It certainly wasn't a disaster. It might have even been a minor success, nothing to be triumphalist about. But that was the analysis. It was like, they make money. What could go wrong?
They have a stadium. It's big. People go to it. They make money. Let's buy the stock. Yep.
That was it.
Yep.
That was
We've
it.
all done it, guy.
I've made much worse decisions from since that time.
Mine
so
was,
that was that.
First solar guy, and basically my analysis at the time was, solar's kind of cool.
Yeah, and he's first, and this is first.
Yeah.
Yeah. So it's, that was the beginning, and then, well, look, as you know, unfortunately, in any kind of learning environment, when you're trying to master something, you're probably gonna throw away about 98% of what you learn, either because it's not worth anything or because it's not valid, it's not useful for what you're going to end up doing. But having that periphery vision is pretty useful to have. So, in terms of technical analysis, I'm not much of one, not much of a fundamentalist either. And it's only because much of what's in technical analysis doesn't obey laws of logic. And so my journey became one of trial and error, a lot of trying hard, not getting wiped out, and then realizing that some things that look really amazing and shiny are being effectively peddled by marketers, not analysts. So I had that academic knowledge behind me to know, hang on a second, something doesn't feel right here. But it was being very well communicated and well sold. And so I went through that journey. I know you went through that journey as well. It's a hazard of the retail, education business, I guess.
People don't make it through that journey, quite frankly.
Yeah, well, a lot of people don't because they run out because they're being charged too much and this and that and the other. But having got through that, where I ended up was with the combination of the academics that I had behind me, and now some good black eyes and punches in the face. I realized that for me, at least, the only way to go was with something I could explain to a lay person in logical terms, through the lens of supply and demand. If I could make a case that a share had more demand than supply and was looking ripe for going up, then that would be a logical place to go, and the opposite for if it was going down. And that was and I developed my own indicators on that as well, that have their basis in logic. And that way, I never have to stray particularly far. It saves me a lot of time. I can stick to logic. And if the logic isn't there, then it's okay. I just move on to the next one or wait for the next opportunity. So it's been a tortuous and long journey, but where we end up is in a really good place, which saves a lot of time.
In terms of you were talking a little bit about technical analysis, fundamental analysis, and then how that kind of, it's not that you don't use those at all, but it's not the foundation of what you do. Supply, demand, and the basic understanding of how supply and demand works, which is a 1 + 1 in the market. You have additional demand, asset prices go up. You have additional supply, asset prices go down. It's the only 1-to-1 in the market, quite frankly. And so you kind of landed on that supply and demand. How that usually, when I hear people talk about the supply and demand equation, I usually equate that to an equity trader, an equity investor, somebody who's simply looking at a stock or a commodity or a currency or any degree of singular asset class. But that's not where you ended up in. You ended up into a complicated world of trading options. And that's kind of your thing, is trading options. And obviously we all love trading options, but supply and demand is just one equation in the value of options. How'd you land into the world of options?
Well, I specialized in it on my MBA because and the fundamental reason was that, well, if you're good at stocks, then maybe options can help you make more profit more quickly. And that after a very long journey, that's where we've come full circle. So 8 or 9 times out of 10, the way we trade options is as a proxy for the stock. We
Yeah.
try to eliminate every other variable that options can carry with it, like the implied volatility. We try and take that out of the equation and say, look, get good at trading stocks, and then you can apply a very simple option strategy to it. And from that, you can build legs from there. The issue with options for most people is they suck at trading stocks, and then they're told that if they could trade options, they'd be better. But actually, they just lose
No,
their money more. They just lose their
that's
money
not how it
quicker.
works.
So yeah, but it's interesting how that's communicated. And so most people who go into options actually don't yet know how to pick a stock, and that's obviously ruinous for them. So and then they think, well, if I did this strategy or that strategy, if I did a credit spread or something like that, and then, well, it's ruinous because you have to have a very high win rate for credit spreads to be effective. And so you better focus first on having that high win rate if you're going to do that. And then you can attack options. So so options, although I built this engine for any option strategy, and I had some fun showing it to you the other day. I love showing it to someone like you as well, because I get the appreciation. Some people, they go, okay, I need a bit of time for this one, but you got it immediately. So that was really gratifying.
I see it through an educator and a trader's lens, Guy. And there's a lot of softwares out there, but when I'm reviewing a software, I always typically view it through the lens on how will this help people both understand and apply what they're learning. And that's what I was impressed with. Well, I've always been impressed with your ability to take the complicated and make it simple. And you've both done that from an educator's perspective. That's what you really kind of focused on in as an author as well. But from a software perspective, this is where your focus has been on in recent history, is taking that knowledge that you've acquired along the way and what you've tried to share both in your, speaking around the world, your multiple different books. But now from a software perspective, let's talk about that for just a second, your journey into software, why it's important to you, and kind of where you're currently at from a software perspective.
Well, that all goes back again to the MBA days. So here I was, got this great new shiny new toy called Options, and the software back in the mid to late 1990s just sucked for it. It was just horrible. So
I was around in the 90s. I came around in 2005, but
yeah,
I was familiar with the softwares of the late 90s, even in 2005.
Well, they're just horrible.
They weren't good. They weren't good.
And so I thought, right, well, I just better build my own. So I started building my own, and then some author at the Financial Times saw it, and it goes, because I had the education woven into the software as well. I built this huge engine, and he goes, this is a book. You could write a book. I'll introduce you to the Financial Times. And that's where I got the book contract, and it became a bestseller. But I wrote the software from the perspective of, I need to be able to see what's going on visually, because then I can understand what is going on with my trade. And that was a very simple concept, but there wasn't anything else at the time like it, or certainly not as gratifying on the eye as it. It's like anything. You could have 10 different things all saying they're doing the same thing, but one might shine out as doing it in a nicer way that appeals to you. So I did it in a way that appealed to me, because, I did the academic stuff, but I didn't find it easy, and I translated the entire options syllabus of our professor into pictures, and that's what I did with the software. I translated everything to do with options into pictures, but simple pictures, intuitive pictures that moved as well. You could change one little thing, and something would move, and you go, okay, I understand what's going on here, and there'll be a logic to it. So that's been my entire philosophy of anything in terms of trading and the software as well, that it has to follow a logic, has to be easily interpreted, and got lots of nice shiny light bulbs flicking over saying, aha, I get it, I understand it. And it's a bit like the Greeks with options. I've had people in my classes, and for 20 years they never understood, they just gave up, and I show them one thing over a 2 to 5 minute period, and they go, oh, I get it now. And that's very gratifying. And I think more people should have access to that. But it was also to do with this. My philosophy on software is this: it's there to make your life easier, It's there to do things quicker, and it's there to get you more focused. And if you accomplish those things, then you spend less time wasting time on things that won't work or can't work. And therefore you can focus more on quality, not quantity. And that's my whole philosophy driving the software application that you saw the other day was, let's make this quicker for you to find quality, because then you're not going to be wasting time. So imagine that you spend an hour saying, right, I've got this next hour to find a great trade. And 99% of that hour, or 59 minutes of that hour, are spent not finding quality. Now, you've invested an hour of time, and the way that human nature works is they feel that they are owed a trade for that effort.
They do.
And so they end up putting on a not a very good trade. So if
they're
you
going to
are
sit
going to
down
spend
for an hour to do some research and they're not going to end with the conclusion of pulling the trigger, they don't feel good about it. It's true.
Yeah, and they may make a silly mistake as a result. So what my aim was to do is look, knowing that's what human nature is, and by the way, that's my human nature as well, is that if I'm going to do it, I either have to be very happy that there's nothing there, but the way I'm going to be happy that there might not be something there to do on that particular day is when I know that I've gone through the best opportunities I could possibly found in a very quick space of time. And so
well, and
that's
very quickly, Guy, I don't think there's anything wrong with the desire for individuals to sit down and spend some time and have a proper conclusion. Like if you dedicate an hour of your day to doing your daily routine as a trader, as an investor, the end result of that should be applying the effort, the analysis, the impact. And so I totally understand the desire, but you got to be efficient in that process as well. You can't just say, I want to spend some time and have a result.
No, I mean, and also you also want to make it so it doesn't take an hour either. You can make it be less for most people have less than 1 hour a day to play. So you have to make it enjoyable. You have to make it fun. You have to make it very clear what they're trying to do. Obviously, being self-directed, there's an awful lot of distractions when you're self-directed, of things that won't work, don't work, can't work, will never work. And therefore, again, the approach to software has to be, here is a philosophy that we apply for trading. Here are our rules. So we have market timing, we have stock selection, and then we have our trade plan. And now you are confined in a space of logic and also enjoyment where you can get the job done very quickly because the software is designed to help you get to the answer quickly. And if there isn't a decent one for that day, for whatever reason, you're happy because you know there will be at some point in the future.
Well, let's get into the end result of that efficiency very quickly, Guy. Regarding your philosophy, your trading philosophy, your investment philosophy, as a younger trader, you were primarily on the equity side, you were learning the options side, you became an expert on the options side. What about today, Guy? That was 20 years ago.
I basically,
what about today?
Yeah, it's equities, and then you supercharge it with options. But sensible options. We call it smart leverage, and because there's dumb leverage and there's smart leverage. And smart leverage is safer. It's in some ways is less exciting. But if you think about buying an at the money or out of the money option, that's dumb leverage, because even if the stock does nothing, your asset is going to waste very quickly.
Yeah, you'll lose everything.
And there are people out there teaching people to buy the basically, how do I put it politely? But they're teaching people to buy these high risk options that are expiring around the corner. Yes, of course, if they get it right, they'll make a lot of money. But if they get it even marginally wrong, they'll lose everything. And of course, it's like that rule. I can't remember which rule it is, but if you lose 10%, then it only takes 11% to make it up. If you lose 20%, it takes 25%. Lose 25% takes 33%. Lose 50%, you've now got to make up 100%. Lose 100%, well, yeah, what's going on there? So we take the philosophy that, look, you can buy deep in the money options safely, but we use what we call smart leverage, which means you're buying low implied volatility stocks, options rather, where you're not paying much for the time value. You're limiting your exposure to time decay. You're buying intrinsic value, but you're still getting a really decent leverage multiple, anything from 3, 4, 5, 6. from that side, that's plenty of leverage. And you don't need to be going for 10, 20 leverage where the risk is too high. And if nothing happens to the stock when you buy deep in the money, yes, you could lose, but it's not going to be nearly as much as if you had bought an at or out of the money option where you're going to lose 100%.
You know, a couple things to that guy. I'm sure this has happened to you many times in your career, both as a trader early on and as an educator throughout your career. But how many times have you met an individual who was right on the direction of something, but wrong and lost money despite being right on the direction of something, obviously talking options, but ended up losing money and they didn't understand why?
Yeah, so I've got one word for you there, or two words even. Calendar call, a calendar spread. It's the one that it's so often because the initial yield of a calendar spread could be 30% quite easily, but the tutor doesn't know what they're talking about in terms of, well, when do you make that? Well, you make it at the strike and never anywhere else. And if the stock goes up by too much, which is quite easy to do on a calendar, you could be losing money. So you could do, wow, the stock went up by 30%. Yeah, I lost. How did that happen? And that's when I bring them into the software. I go, let me show you what happened. And they go, oh, they never showed me that. I go, no, because it's only here that you'll see that. So it's one of my favorite parts. It's one of the favorite parts of my options course, that one.
Well, let's talk about that a little bit. And if you want to show us some visuals, that'd be great as well. But in terms of, you mentioned the calendar spread, and that's a good way to go about it because you're dealing with two different sets of options there. They're going to have a different impact. In terms of how, you know, your career, you've spent a career trying to, you know, teach people the differences between how an option is priced, right? The difference between delta, theta, vega, gamma, rho, how they impact one another. But from a software perspective, you keep coming back to, let's make this simple. Let's make this simple. Let's make it visual. How do you go about taking something so complicated as the option Greeks and making them so easy to understand from a visual software perspective?
Well, you start right at the very beginning. So, for example, one of the things, I'll actually draw this out. So we're going to freewheel a bit here.
Let's go on this.
But where I started was, this was a long call, and you have a little grid. Sorry, I'm very bad at drawing, but you have a long call.
You're Michelangelo in the making, my friend.
That's not going to be. Long call is there. Well, what's the opposite of a long call? Just do the mirror. A long put, right?
Mm-hmm.
Well, what's the opposite of a long call as well? Well, it's a short call, right? And each one, this is what I call the rule of the opposites. And then what's the opposite of a short call or a long put? Well, it's a short put. And so you start from here and they go, okay, because as the stock goes up from left to right, the long call makes money. As the stock goes up from left to right, the long put loses money. And so everything is the opposite of everything. Long options have unlimited reward, well, at least till stock gets to zero on a long put, but limited risk. Whereas short options have unlimited risk and limited reward. You pick up the premium, the maximum profit you make is the premium. So you start from that. So it all actually starts from one picture, that is long call. And from there, you can build everything because you just do what we call the rule of the opposites. And then once you've built that framework up, you go, and by the way, these are expiration lines. So I'll draw you something else. So if this is a long call at expiration, well, in the meantime, what will happen before it gets to expiration, it'll be a curve. And the nearer you are to expiration, that curve will get closer and closer to the expiration line. So it moves. And of course, during that time, all the Greeks start to move as well, which we won't go into just yet. But, you know, I just started from that. I remember doing my exams. That's exactly where I started my whole options adventure. From just that one diagram, and then I built everything else around it. And so the answer to the question is, where do you start? You start there, and you build. Everything is a block you build on top of, and it's all logical, and that way people don't get overwhelmed. Now, the way that I was taught on my MBA, we went right to Z, or Z as you would call it. We didn't start at A, let alone going through A, B, C, D, E. So I just started at that, and I think people have to realize, and this is where it's a little difficult because of my, position in the industry, is that I started right at that ground zero point. That's what made sense to me. Conceptually, I didn't get it. So I had to start right at the beginning, and I made that picture for myself. Now, when I started showing those pictures to people, people go, "Oh, that's good. I understand that too now." And of course, it resonated, and it just has continued to resonate. But even with that, you still got to understand how to trade stocks first, because no matter how clever you are with options, if you don't know how to trade the underlying asset, then it's not going to go that well for you.
So in terms of step one is to learn the equity market. Step two is to understand and start learning the options market and how the options market overlays on top of the stock market, because
that's right.
Options
At least for us,
that.
yeah.
They're derivatives of stocks. They
That's right.
derive their price from the underlying stock.
There
and
you
so
go.
on the stock side of the equation, you talked early on about how technical analysis is what it is, fundamental analysis is what it is. They can give you good reads, they can give you misreads, and that is the difficult thing to understand. Is when you read a chart, and I'm a technician, when you read a chart, you read left to right, you read the historical understanding of trends and patterns. When you're looking at it in the current moment in time, the difficult thing about technical analysis is deciphering the pattern, the probability from what could transpire next from a variable perspective. And it can be very, very difficult oftentimes. It's easy to read it from left to right on a chart. It's a little bit more difficult when you're doing it in the immediate moment of time. So you kind of navigated to supply and demand equations. Can you talk a little bit more about that? If step one is to learn the equity market, and how Guy Cohen reads the equity market is from a supply and demand perspective, can you give me a little bit more understanding of exactly how you read that?
Absolutely. So if we're talking about supply and demand, which is what we do, we're looking at, well, what's going to move the markets? That's ultimately, you could go back to bags of sand and spices, 2,000 years ago, and again, all moved by supply and demand. There's no real difference to the stock market. And so I landed over time on a hypothesis that this was the way that I wanted to go. So I'll go through them with you guys. There were actually, in terms of the entire blueprint, we have 3 simple steps, which is market timing. Obviously, I want to be on the right side of the tide. I don't want to be fighting the tide of what's going on in the market, number one. Then we have stock selection, and then we have our trade plan. So this is the 3 master keys that govern our entire approach to trading. But we'll focus on, actually, this is a pretty good one. I didn't know I had this one. Let's do this. This is kind of fun. So we're going to get into what I call the big money footprints in a second. But this is a cool little visual, if you're okay with it.
Yeah, 100%.
Why prices move. So I asked people, I said, well, look, picture your dream home, and I'm going to give you 3 scenarios. And each scenario is actually going to contain a really important lesson, which you can
The only thing I'm thinking about very quickly before you go on, Guy, is the asking price for that home in America is not $950,000. That's all I'm going to say.
9 million.
Yeah,
no.
9, add a 0. And
I know.
Yep.
Let's make this aspirational. Let's do this house in 1972.
That is more accurate, my friend.
But okay, so the idea is this: the big money on its own isn't quite enough. So imagine you got the first scenario where everyone's bidding the same. So you're going to offer $950,000. Bob offers $950,000. Sue and Jim offer $950,000. What's happened?
Offer the asking price. Yeah,
exactly. They're all offering the asking price. So what's the price? Well, it's still 950 because the needle has not moved. So the learning point is that big money on its own has not moved the price. Big money isn't enough. So then we go to scenario number 2. Now we're talking about the world of real estate here, and we're talking about a concept called information, so new information. So the new information is that Google here are building a big headquarters of 5,000 employees, 5 miles down the road, all going to be well heeled, all going to want new facilities, and so everyone gets
$250,000 a year in salary. Yep.
There you go. They're going to want facilities. They're going to want roads, schools, cinemas, eating venues, leisure facilities.
They want lifestyle. Yeah.
What's going to happen to the area? It's going to get better. So Bob says, okay, I think it might be worth a little bit more now. Going to offer 960. Sue says 970. You say 990. Jim says 1 million. You now offer 1.1. So what's actually happening here? You've now got a bidding war that was fueled by new public information. So big money on its own wasn't enough. It was the aggression of that money. It was people willing to climb on top of each other to move that price. And it works, of course, both ways. So now you've got the demand. Now, scenario number 3 is where it gets really interesting, because now imagine that Bob is very good at his due diligence, and he's walked around the area behind this property, and he's seen there's a big parcel of land here that's owned by an old couple, and they have not got that parcel of land on the market, but they're willing to sell privately. And now he is the only one with that information. What he can do is he could buy this house, he could then expand it at the back, he could build another development. He's now got that information that no one else has got. And so he is now prepared to pay more than anyone else because he knows the real value. And what that real value is scarce information. If we can get into scarce information, well, then we're really in another place. And so that also governs my approach to this. So if you look at
what everybody knows, is what you know.
Exactly. So if you have scarce information that not many other people know, then it can lead to a repeatable system, can lead to repeatable profits. So if you talk about diamond dealer, we go to diamond school, they know the cut, the clarity, color, source, carat, the whole thing. And they typically make 100 to 200% markup. Coca-Cola, their scarce information has fueled a multi-billion-dollar business over 100 years because it's their secret formula in that vault in Atlanta. And then, of course, KFC, very similar situation, multi-billion-dollar business based on a recipe of greasy chicken.
Mm-hmm.
So that gets life interesting. So I adopt the same philosophy of, and we call it big money footprints. So now go back to the stock market and then let's have a look. So the first thing we talk about is recent volume acceleration. So, and where we're looking for here, I think in terms of what are we really trying to understand here is there a reasonable hypothesis that you could say there is accumulation here on the way up or distribution on the way down? Because if people are hoarding on the way up, let me give you this scenario here, because this is kind of fun. Imagine that there's 1 million shares. Okay, I'm writing this very badly. Let's just do that one again.
No. We already determined you're Michelangelo in training.
I know, million shares. There you go. A nice round zeros there. Million shares, and that's in the float. Okay, so there's nothing that's going to change that.
And the float is the total outstanding shares.
That's right. And imagine that 800,000 of those are just, up for the churn. Okay, so they're floating around. 200,000 have been hoarded effectively. So let's say minus 200,000 there. Now imagine that there's a big, a lot of buying going on, and it is hoarding. It is accumulation, which we don't know it's accumulation, by the way. And imagine that's now, minus 300,000. So they've been picked up, which leaves you, of course, with 500,000. Now, there's no indicator in the world that will show you that that's going on and those 300,000 have been hoarded. But what happens is with the same amount of demand on those 500,000 is going to push the price up compared to what it would have done with the 800,000. You've got fewer in the supply, but there's not one indicator anywhere that will show you that. So the only thing we've really got here is a little bit of educated guesswork. So how do we do that? Well, with volume, we have potentially a price going up, which would be green on the stock price and the bar on the stock price, and the volume bars would turn green. If you have acceleration on that, then maybe, just maybe, not definite yet, but maybe there could be accumulation going on the way up, and maybe, just maybe, there could be offloading and distribution on the way down.
Yeah.
More than just the churn that you normally get. That's big money footprint number one. It's not definitive though.
So before you get into big money footprint number two, it's like Bigfoot, big money. I like that one too. On the volume side of the equation. So just that helps you understand, and again, increasing volume, additional accumulation, increasing volume on the bear side, more distribution. Very simple. How you describe, increasing participation versus decreasing participation. But in general, I want to get back to the point. The increasing volume is basically contracting the float, which means in the future, each dollar move will have a greater impact to the top side, because you're not going against a million float now, you're going up against 500,000 share float, correct?
Potentially.
Potentially.
Except for the fact that there's no indicator in the world that will show you that those shares have been hoarded.
I just wanted to kind of just wrap it in my head to make sure I was getting your point there. Okay,
right.
What about big money footprint number 2?
So big money footprint number 2, sorry, I've skipped one here. Big money footprint number 2 is recent price acceleration. So imagine there's been an event. The thing is, my bottom of my screen is
a positive earnings report.
Just say you've got that. Just say you've got a little bit of positive earnings report here, and there's been a jump in the price. Now, when that happens, something very important also happens, and that is eyeballs get alerted to it. So people are watching, which means the potential.
Talking about it. It's out there on Twitter. It's on YouTube. It's on CNBC.
Alerts on professional desks, hedge fund desks. They're going, hey, Bob, what happened there? Do we need to look at this stock? It's gone through a certain level or whatever. And so more attention means more potential for activity, more potential for demand or supply. And then ideally, after that initial thrust, that's not the end of the show. Hopefully, ideally, it goes sideways for a bit or just drifts off a little bit, consolidates, that pause. That's ideal. So that recent price jump, what it does is it shows that the stock price is responsive. It might be taking a rest, which gives you an opportunity to think about buying it. And also lots of eyeballs are now on this, analyzing it and considering what to do as well. So that's the second component, big money footprint. The third big money
footprint 1, increasing volume. Big money footprint number 2. How I would describe that is increasing momentum.
Yes, that's right. And I'm just talking about, the way you would see it from the lens of, let's talk about the lens of buyers versus sellers. So it could be, and this is by no means still definitive, it could be that more buyers are getting involved here, buyers potentially beginning to take over. Okay, so then you get to the big money footprint number 3. And this is really simple, and it's all about eyeballs on this. And this is a self-fulfilling prophecy. There's no magic in it whatsoever. But the 200-day moving average is one of what we call key levels that people are looking at. It's got alerts and alarms on many trading desks. Many filters are looking at this 200-day moving average. Now, it's not definitive in itself. It's certainly not magic, but it is just a case that eyeballs are looking at this line. Eyeballs are looking at activity at the 50-day key level, and even to other levels as well in lesser effect. And again, what we want is that volume of eyeballs looking at it. Now, when a stock crosses one of these and then maybe pause and other things are in play, it could be that attention then stimulates more demand. Could be. We're still talking in a world of could be, but at least we now know for sure it's getting looked at by a lot more people and systems than before. Now, that was made famous by Paul Tudor Jones, the 200-day moving average, of course, but there are others as well. So that's big money footprint.
We love moving averages at Tackle Trading and the Trade Justice podcast. There's no doubt.
Yeah. So and that's one of the reasons, because a lot of people. So you're kind of almost proving the point in that sense. Now, we talked about scarce information earlier, and this is big money footprint number 4.
One quick thing on that one, Guy, before you move on to number 4.
Sure.
It's one of my, because you're describing a little bit of kind of my belief in technical analysis and why technical analysis works. It's not that these moving averages are these magic lines that just magically appear. I've described it as that self-fulfilling prophecy to a certain extent, where you're trained on it, I'm trained on it, the hedge funds are trained on it. We all read Paul Tudor Jones. We're all familiar with his work, and it's this self-fulfilling prophecy of all these different traders, different investors, but all have somewhat of a similar foundation and understanding. and they're all looking at that, for example, the 200-day moving average, right? They're all kind of hesitating and saying, no, you first, you first, you first. And then once you see it break up above the 200-day moving average, oftentimes we see a little bit of momentum because we're all just waiting for that first person to have the courage of their convictions to get above that 200-day moving average. I love the conversation here, Guy. What about big money footprint number 4 here?
So big money footprint number 1. Now we're getting into scarce information. This is information that not many people know about. So this is going into my options volatility indicator. This is the OVI, as we call it.
Yeah.
Now, we talked about this the other day. There's a whole big thing in the retail market right now going, oh, unusual options activity, and it's the whole big thing, except for nearly all
around the market every single day. 0 DTE, unusual options activity. With how algorithms use 0 DTE, it's really hard to spot that as an individual investor without software. That's really hard to spot.
That's very true. Now, we don't use unusual options activity for one very, very simple reason. That is, nearly all those spikes in unusual options activity are intraday churn. So
100%. They're all 0 DTE.
So this is the situation. So everyone, like usual, being misinformed, and there's people making money on education for the wrong reasons. So we pioneered this back in, well, we were one of the early adopters of this sort of thing way back to like 2008. And the OVI doesn't look for unusual options activity, but what it does do is it looks at all aspects of liquidity and pricing of options. That means implied volatility on the pricing side and volume and open interest on the liquidity side. So it's looking at a much richer, a lot more data, much richer information sources. And that's why it got patented, because no one else is doing it. But there's a really important reason why looking at options data in the way that we're doing it has validity from a logical point of view. So let's just imagine that the OVI has turned blue for bullish. It can turn red for bearish. Now, does that give you every answer you want? Of course it doesn't. We're talking about context here. It's another big money footprint, but it's a really important big money footprint. A, because it's scarce, and B, because it actually does have mathematical and quantitative validity as well. So we know that, and obviously we're using it in automated systems as well. But from a retail trader perspective, imagine this scenario that you have other big money footprints pointing bullishly. And now you see this indicator that very few people can see. I mean, we're literally measured in a few hundred people seeing this indicator. Now, there are tens of millions of people who trade the US stock market. So do you think we're going to make a dent even if we've got 100,000 people? No, not even a scratch, because there's obviously, hundreds and hundreds of stocks. But it's very scarce. Very few people know about this. So that's one bit of scarce information. The other part is that it has that, patent, but also has the empirical substance to it as well. But imagine you've got, a collection of big money footprints all pointing bullish. And then the OVI is blue as well. What does that actually mean? Well, it basically means that in very crude terms that there is some form of momentum in the stock, some kind of activity pointing bullish, and even the options traders through pricing and activity have also turned bullish on this as well. We look for a little bit of not just a one-shot deal kind of thing. We need it to be persistent as well. Now, what does that mean? Well, it does mean this, that if in very crude terms, call buyers are taking control, someone has sold them those call options, and that'll be the market maker in many cases. Now, if the call buyer has limited risk and unlimited potential profit, and has the right, not the obligation, to buy stock based on that call option, then the person that sold those things to them has the opposite thing. Remember at the very beginning, we talked about the rule of the opposites. So the call seller has limited reward, i.e. the premium they took in, but unlimited potential risk, and they have potentially an obligation. That obligation kicks in if the stock price starts to rise. And if it rises enough, they start to get scared, because then they have that obligation and they have the unlimited risk. Now, if that happens, they've got two options to hedge their position. The first option is to buy a call to offset the call that they have sold. And imagine this is hundreds of things or thousands of the things. That's one way, because they can hedge their losses in that situation. The other thing they can do, but that kind of kicks the problem down the can, that kicks the can down the road a little bit. The other thing they can do, though, is buy shares.
Mhm.
Now, imagine that. You've already got momentum going on in the stock, and you've got other big money footprints suggesting this is going up. And now the short call providers, the people who provide liquidity in the market in the options world, are also now joining in for more demand. It's like a hidden short squeeze. There's a short squeeze that no one else can see, potentially. And that's why then that extra thrust of demand can then help push the price of the underlying stock up yet further. And that's why this is important, because it has an effect. There's a domino effect that can happen. Does it happen every time? No. But
no, it's all based on probability analysis, but that's the entire market here, Guy, is just trying to get
building
get
up
as many tailwinds as you can get behind your back to make your journey
exactly.
a little bit
We're
easier.
building up, we're building up evidence here. So that's big money footprint number 4. And it's
by the way, my lawyer mindset here, Guy. I just love the step-by-step building it. You're building the case, right? You're building
the case.
Do we have volume? Do we have momentum? Did we break through a catalyst? Do we have a positive reinforcement from our indicators such as OVI that you use? Other traders might use other indicators, but like, I love that you're building a case that leads to a conclusion, evidence to conclusion. Oftentimes, I see it in life, I see it in trading, I see it in politics, I see it everywhere. People form their conclusion and then they try to find their evidence to support their conclusion. Not evidence to conclusion.
Confirmation bias.
I love it.
Yeah, because most people look for confirmation bias. We don't have to do with this. And of course, everything that we're talking about here has a supply-demand theme to it. So then we have this is another proprietary thing we do, and this was a really cool thing. This is, apart from the OVI, it's the most difficult thing we do, and I can happily say, as of right now, as of last week, that it absolutely has empirical substance to it as well, and it will be used in our automated hedge fund situation. So I'm very excited about this one because, again, it's another unique thing. Now, I want to show you this thing. Now, what you see in front of you looks like a reverse head and shoulders, doesn't it? I mean, it looks like what other people call reverse.
How I would describe it.
Yeah, so you've got to move down, followed by a bit of a retracement, then another move down, forming a lower low. It doesn't have to, but it could do. And then you have another one. Now, this is really important. What's actually happening is not a head and shoulders, because the head and shoulders is just a pretty name for a pattern, right? It doesn't mean anything. But this is what's actually happening. Move number 1 is greater than move number 2. See, this move here is bigger than the second move. And then both of them are quite meaty. So move number 1 could be, say, I don't know, minus 40% over 4 months, whereas move number 2 could be minus 20% over 3 weeks.
Yeah.
You never know with this. This is why they're very difficult to find what your time frame is. And the third one is either another retracement, shrinked, or it could even be a little consolidation. It can be. But what you're seeing here in the context of big money footprints, you're seeing here potentially buyers taking over from sellers, sellers running out of steam is what we're seeing here. That move there could be, this little move up here, could be that big thrust with the big volume and the OVI turning type of thing. So look at it like that. And of course, on the other way, you could be having up moves diminishing in scale. This move number 1 is greater than the second move. And again, it doesn't have to be forming a new high. These don't have to be beautiful patterns each time. And then you get the third one here. So let's just go back there.
Can I say something to that one very quickly here?
Of course.
The concept you're describing here is a concept that I call just, it's simply put, slowing momentum in trend. And basically, how many times I see traders look at, say, on the bullish example where you have slowing momentum in the bearish downtrend. How many times I see traders look at that first retracement after slowing momentum and they're like, "Ooh, this is a really good short," and I'm like, "Is it really? All the pros are done here. Like, where's that additional volume going to come from?" It's slowing down for a reason. Now, obviously, on the bull side, it happens more because most retail's on the bull side, not on the bear side, and rightly so. When you're looking at the bull side, you have this amazing move up, right? You correct back down, gives you a nice little buying opportunity. It then goes up, breaks out again, but doesn't create the momentum. And one thing that I've noticed in these big money footprints is momentum plays a tremendous role in your analysis, Guy. And it does me as well. You and I have commonality in that. I can't look at a chart and not see either increasing or decreasing momentum and the impact that has on my read on where that equity is going to go, either up or down. It's number one is momentum. Can you speak a little bit to the importance of understanding momentum? And when you're not necessarily from the stance that you just did, because that was beautiful, Guy, but from a stance of don't fight the momentum, when you see slowing momentum in a bullish condition, there's a reason that is slowing down. Don't be the trader that says, I'm going to create the momentum. Can you talk about that a little bit?
Yeah, and it kind of it's this one, isn't it? It's trade what you see. I mean, don't try to use your confirmation bias to say to try and fit what you believe. Like, a lot of people do that in a political sense. They believe something politically and that translates to, their trading, or
our
it's like
human behavior rinses and repeats from the finance to the political arenas.
Yeah, but even to sports, to religion, to belief systems, to the whole thing. I mean, everyone, there's a lot of things we could talk about, but confirmation bias is the big enemy here. So trading what you see is one of the big things. And of course, what we're looking to do here is build up that evidence. So again, in momentum terms, it's a
build a case.
It's a completely legitimate way of interpreting what we're doing. It's a slightly different way of saying it. But we're looking at, this is the momentum. Well, this and big money footprint number two are the momentum pieces.
I just love how you put it into the language of big money footprints, because when you put it into the pure technical language, people don't understand it, Guy. Believe me, I've tried many times. I've tried to just put it into the technical language, but they don't understand it.
No, they want to see
it into their language. They do.
If you describe it as buyers versus sellers, what are buyers doing here? What are sellers doing here? Then that makes sense. You can get more involved in that one. So here, and I'll show you a real example in a minute, but here, sellers are beginning to run out of steam. Buyers look like they're taking over. And of course, if there is a key level here, if there's OVI here, if there's momentum and the volume, if those are present as well, now you're not always going to get a full house, of course, you can then say, well, okay, it looks like here sellers have run out of steam, buyers are taking over, and now there's an opportunity to at least get to a conservative first profit target, because that's the number one aim we've got to do here. And of course, on the way up, it's the same. And how many times have you seen a stock that plummeted, then you look back and go, oh, there was a head and shoulders there.
Oh my goodness, there was slowing momentum. There was
so many times. Buyers here are running out of gas, running out of momentum, and of course they can't push it up the hill any further.
You're looking for the identification of the momentum, meaning you want to see big increases in volume to make it stick. You want to see a breakout of some degree of catalyst to catch some momentum in trend. And as you work into late stage, you start looking in slowing momentum to see the trends getting exhausted. And that was one of my questions before you got into this shrinking retracement conversation, was at what point does Guy Cohen see that you need to start tapping on the brakes on the bull side? And that's kind of what this conversation is here.
Well, I'll get there. I'll finish the sixth and I'll give you a real one as well. So the sixth big money footprint is, now got to be careful here, it's a price and volume consolidation, but only in the context of the other big money footprints as well. Now, most technical people will be horrified to know that a flag, the favorite pattern of O'Neill and other things, and mine, by the way, and consolidations, actually have a
I haven't met a trader that doesn't like a good flag.
Right. Except that there's one big problem with them. They have, like pretty much every other technical analysis scenario, has a really bad win rate, especially in isolation. They have to put things in context. And this is, I think, the big part of our conversation is, look, guys, at least from my perspective, these things are all contextualized with each other. Now, the biggest use I have for consolidations and flags is for my entry points and my initial stop. That's my biggest use for them.
Mhm.
But there are times where it also becomes a big money footprint as well. And that time is in the context where this sideways movement, which has come after, typically after a move, is coming with reducing volume, so that this movement here, this drift, is not being accompanied by increasing volume.
You don't want to see a battle up there. Yeah.
No, basically it's just drifting because buyers are exhausted, but guess what? There are
Sellers
no
aren't doing
sellers.
anything. Yeah.
But there are no sellers either, which means the next bit of activity, which will hopefully be buying, will be enough to meet very little resistance and then force you up at least to a conservative, what we call P1 or first profit target. So in the context of other big money footprints being present, then a price and volume consolidation can be very, very useful as well. Now, that's the 6 big money footprints. Let me show you them all in one hit. So this was just a poster child for big money footprints. And sorry, for some reason, this little bar at the bottom is, how do I, maybe I can show it. Oh, maybe I can do, no, I can't do that. Well, I tried, never mind. Oh, there you go, it's gone.
Yeah,
Hooray.
I can see the volume now.
It's gone now. Okay, good. So this is Sarepta a little while back, and it's just beautiful. It's just beautiful. Let's have a look at it one by one. So here's big money footprint number 1, big volume. Now look where that big volume is. It's near the bottom. It's here, right? This is still, to all intents and purposes, for most people, bearish at this point. But we're seeing an uptick in volume, which is interesting. Just interesting. And we're seeing at the same time big money footprint number 2, which is a thrust in price, you know, from 63 up to 77. That's a pretty decent clip of price action there as well, with increasing volume. Now, as it happens, you can also see it's gone right through at least one of the key levels, the 50-day key level, which I love. It's soon going to go through the 200 as well. But 3 big money footprints all there. Now, also at the same time, is guess what? Look at the personality of OVI. It's been mainly negative, or not really anything that's particularly useful to us, to now changing to be persistently positive. That's interesting too. So at this consolidation here, you're thinking, this could be interesting on a breakout. You've got 4 big money footprints there, except for you don't have 4, you actually have 5. Have a look at this. Look at this move here. 1, 2. There's your shrinking retracements spotted. The first retracement came from $90 down to 63. It's a pretty decent move. That's, you know, you're touching, you know, 37, 38% there. The second one goes from 75 down to 65. So you can see visually, even if it doesn't come in pattern recognition, that sellers seem to be running out of steam. And then you get to this one here. Well, guess what? They're really running out of steam now, because it pops up above the 200. Now, you could take that one, or you could take this little one. You don't know it's coming until it's happened. But that also happens to be 2 consolidations with volume consolidating at the same time. So there you've got your full house in a really neat and tidy chart on Sarepta. And of course, it moves, you know, very strongly after that. But that's the thing that we really, really like. The only other thing to show is that often in this situation here, you might have had earnings. Instead, you had earnings in August up here and then below in May. But that's it. And that is the big money footprints all together. Now, you won't all, it's not that often we get all of them being recognized with pattern recognition, because pattern recognition begins somewhere and ends somewhere. There's always a cutoff point. But that is what you're looking for. And of course, if you look at this chart, you can see, yeah, I can make a case for buyers starting to take over, both in the stock and in the options. And it's clear to see. And this is the thing of, this is the Michelangelo you were talking about.
Yeah.
You were, but this is what I call Michelangelo. When a stock does this, then it becomes much easier. And you know,
a couple of things here, Guy. I agree with you in the sense that if you just know technical analysis, meaning the only thing you know about technical analysis is trends, patterns, support, resistance, indicators, you know, what is you can correctly identify what a bullish engulfing candlestick is, right? If that's the only thing you know, I do believe it's oftentimes a useless skill set. if that's all you know is the definitional approach of technical analysis. What I've tried to do with our community over years and years and years with technical analysis, because I do believe to my core in technical analysis as seen through the eyes of behavioral analysis, because technical analysis tells a story and you have to understand the story. And the story doesn't start with the trade you're making today. The story starts with the ending of the previous trend and the saga that went in from a momentum perspective and the contraction of the retracements to the increasing in volume. It's telling a story, and you need to listen to the story to understand where the next movement wants to go. And I've always felt like if you can combine your technical analysis and your understanding of trends, patterns, support, resistance indicators with your understanding of what creates the technical analysis, which is the behavior, the behavioralism of people, that will give you an edge that the market is not ready for. And I feel that is truly powerful. And your 6 big money footprints here, Guy, is a very, very great way of helping people understand the context of the behaviorals that go along with the technicals. I loved this conversation, Guy. Thank you so much for taking the time to really kind of detail how you think about the market from a technical, behavioral, and an indicator perspective. I got one last segment, Guy, that we're running out of time, and I do got one last segment, and it's going to be a quick lightning round type segment. But before we get into that, I want to give you a last, just kind of a moment to summarize your thoughts on this conversation we've had so far.
Oh, I love it. I mean, I love it. Look, we're on the same page, which makes life a little easier. Although it would be probably more fun if we were arguing about everything. That would be.
I tried, Guy. I tried to find things I could disagree with you on. I'm like, no, he's reading the chart the same way I do. So no. You.
I would just say that the most important ones to me, the ones I look for immediately, are the key level. The reason why the key level is also very important, I'll just add here, is because when you're at a key level, you are already not overbought if you're looking to buy, and you're not oversold if you're looking to sell. Very important, because if you look at the chart right now, this could be a flag. This is great. Look at this. It's going, but it's way overbought. You don't want to be buying
way
up here.
Overbought, and you're nowhere near support.
So that's another part to that. So it's the key levels are very important to me. I want proximity to those. I want OVI, and I also want shrinking retracements as well, because that gives me the context of where we're at in this arm wrestle between buyers and sellers. So that just to add a little bit of flavor to that. But no, I really enjoy it, and I really enjoy listening to someone else's linguistics on how they interpret what we're saying, because you're talking a momentum, I'm talking, but they're both the same thing ultimately.
You and I, we might have a different way of describing the current condition, right? But they come from a similar foundation in understanding. And what I've always, and from the time you and I first met to today, I've always felt you and I had a tremendous amount of commonality in how we see the world of the market and the why behind a price. And it's not solely about, ooh, that's a bullish candle, or that's a bullish trend, or that's a bullish pattern. It's also the understanding of answering the ultimate question that lesser educators don't want people asking, but people like yourself love, and that's the why of something.
Yeah, because a lot of what goes on is
that way.
A lot of what goes on is noise, and so you have to contextualize it.
You got to cut through the nonsense. It's true. Yeah. You got to cut through the nonsense.
So yeah, no, I like that. Now I just realized if you give me literally 10 seconds to close my door, because kids have come back from school, but I'm here. I'm not going anywhere. I'm just going to literally reach out to close that door.
Close your door. You're just fine. I'll set this up. All right. So last segment here. I'm going to do a little bit of rapid fire with Guy. I'm going to ask him 5 questions. And Guy, really quickly, I'm going to just say a couple words, ask a question, make a statement, and then I want to hear your thoughts for 30 seconds, unfiltered. Okay? Unfiltered, 30-second thoughts from Guy Cohen here. Some serious, some not. right? Some serious, some not. Let's have some fun with this. Okay, Guy, first question. Guy, what's your favorite trading movie?
I was going to say Big Short, but I'm going to say Dumb Money because I watched it on the plane recently and it was fantastic.
Okay, lesson learned from Dumb Money, go.
Oh, well, lesson learned from Dumb Money is don't put all your eggs in one basket, and certainly don't put in the basket where you need margin.
Don't trade dumb money. I like it. I like it. I like it. The role of fundamental analysis in Guy Cohen's personal investing.
Provides a bit of background story, but which ultimately eventually gets filtered through into the sort of more immediate technical side of things. The problem with fundamentals is it's not going to give you timing. That's the issue, and it can also be interpreted in different ways. The ultimate way, so if you can get a combination of fundamentals and technicals, great, but they often don't jive together.
If you could only have one indicator, and it could not be a Guy Cohen created indicator, what indicator would that be?
Oh boy. Oh, that's really do you know what? Oh, could it be a could it be a Tudor Jones moving average?
It could be moving averages, absolutely.
Yeah, probably, because that would at least give me where some activity is happening. I mean, it wouldn't give me very much, to be honest. It would be pretty meaningless, on its own.
Mm-hmm. But if there was one, it would be moving averages.
Yeah, because at least that's the area where I'm looking anyway.
All right. Next question. What is your thoughts on AI?
AI is obviously something that's going to continue and expand and is going to affect all of our lives, as it already is. In terms of trading, you have to be very careful of a concept called overfitting. So when we do our hedge fund stuff, we have to be very careful in the use of AI type of situation. Adaptive is what we call it, where you're using it because the opportunities to curve fit are myriad, and most trading systems will use AI in the wrong way. So just don't get suckered into anything just because it says AI. Like with anything in life, there's good stuff and bad stuff and incomplete stuff and stuff that's just sloppy and slipshod. AI is not the nirvana, but obviously there are going to be some systems that use it very sensibly.
Is Terminator a proper conclusion of the AI saga?
Well, my wife says that that they would eventually want to get rid of human beings. She's this lovely, kind, sweet, amazing mother, blah blah blah, but she just doesn't like the human race.
Strong supporter of AI.
AI to destroy the human race. Yeah, that's kind of well, maybe it should. I don't know. Maybe it's our way of saying we've had enough of ourselves.
All right, next one. Big picture macro. Guy Cohen's thoughts on inflation.
I don't really have any, because you could speak to three economists, all of the highest qualifications, and all disagree with each other. It's a bit like Elliott people. So I just don't get involved. I literally just interpret what I see through the lens of what the chart you're seeing. That's all I look for, because inflation could go up on Wednesday and everyone says that's fantastic because it didn't go quite up as much as they thought it was going to go up. It's like anything to do with news. It can be interpreted in a way that seems completely counterintuitive, and so I don't get involved in that game ultimately.
As someone who understands inflation quite well, I'll be the first to admit it's a snapshot of an environment and damn near impossible to get accurate.
It's not just that though. It's not just that. It's the reaction people are going to have to it as well, because they might be, okay, inflation's rising, and then there's the but that comes after it. And go, well, okay, inflation was rising, but they were happy with what he said about blah blah blah, and what he's going. And so then so it's a very qualitative thing. It's not just a quantitative thing. So I stay out of that.
The market's conversation on inflation in the last year and a half has driven me absolutely crazy, because it's not about what is inflation. It's about what the market impact to whatever Jay Powell is going to say about inflation is.
Exactly. So the short answer to the question, I don't get in. I have no skin in that particular game. It doesn't bother me.
You're like, is it in my indicator and does it show up in volume?
Does it show? Right. Well, how does it?
I like it.
What's the impact? I'll look at the impact on that.
All right. Next, got a couple other rapid fire, just just non-serious, just a little bit of fun here, Guy. Guy, what's your favorite food?
I love those massive crab legs. You know, those big ones, the jumbo crab legs. You know,
I'm a sucker for a jumbo shrimp platter. I'm a
oh
sucker for.
boy,
Oh, yeah, absolutely.
crab cakes on the East Coast, but obviously those big suckers.
Oh, no, no,
you literally they just melt out and they're salty and
I'm
that's
thinking about this hole in the wall joint in New York right now where like you're describing their crab cake. It is
they
so,
had
is it the Pearl maybe? I can't remember the
there was a
name.
place called Crab it's Crab Kitchen or something
So
in
good.
Manhattan. It was amazing.
Yeah, it's this hole in the wall.
Yeah.
I think it was like in The Sopranos or something like that. It was just so good. Last question. We like sports here at Tackle Trading and Trading Justice. Guy, what's your favorite sport?
Soccer, football, Liverpool Football Club.
Liverpool, that's your team?
I love Liverpool. Everyone knows it. I'm brainwashing my son and daughter to support Liverpool. It's a very big job of a parent to make sure your kids support the same team as you.
I've tried and failed at that. I'm still trying.
Who do you support?
Well, I'm a Miami Dolphin fan for football, for NFL. And been that way my whole life. Grew up watching Dan Marino. I've tried to get my kids to embrace the Dolphins, and no, they like the dolphin, the animal. They don't care about the dolphin, the football team. So I felt that guy. If you got some parenting tips on how to
listen, I'm trying. The story isn't written yet. I think we're 70% there, but it's funny in the late 80s, mid to late 80s, but actually early 80s even. The football team I supported, as in American football, which I don't know why it's called football because you play it with your hands, but that's another story.
Don't get us started on why we name things. It doesn't make sense. We just name them.
But mine was Joe Montana, the 49ers.
Montana was great. I put Montana.
And they had that, and then I think it was 1980. Wasn't it 1984? They beat the Dolphins.
I don't want to talk about it. Like, I'm still not over.
Sorry. You're still smarting over it. Was it the final drive? I think it was the final drive as well, as usual, with Joe Montana.
Montana was just the 49ers in the 80s were just something to behold. Jerry Rice, obviously Montana, like they were amazing.
Montana was like, I don't know, he's like Harrison Ford. He was so ice cool. He literally
he's as cool as they come. Nothing gets him off his game. Like he's just cool like that. You know, Guy, this has been such a enjoyable and enlightening interview. Really appreciate you coming on to the pod again. And just a couple final thoughts for you. If people want to get to know a little bit more about Guy Cohen, how do they follow you on social media? Just give us a little bit of closing thoughts there.
Oh, okay. Well, social media, I'm at Guy K Cohen. You can go go through you guys as well. I mean, you can find us, but we call wisetraders.com, wisetraders.com. Have a look at us there and see what we talk about there. We're really focused on the one thing that we do. That's the good thing. You won't be taken in a million different directions. And we obviously we do stuff with one or two partners. We're hoping that Tackle Trading will be one of the partners that we want to.
We're gonna keep talking.
So you can get to us via Matt and his team as well. And yeah, that's probably the best way at this minute in time.
Guy, it's always a pleasure to talk to you, my friend. It's always I always love having you on the podcast. You increase one thing I love about you, Guy, is you want to increase the financial IQ of people. At the end of the day, that's what you're trying to accomplish. And at the end of the day, that's what we're trying to accomplish at Tackle Trading as well. And the more good people that we can connect with to accomplish those macro goals, the better there, guys. So it's been a pleasure today. Thank you so much for being coming on the podcast here today. And by way of podcast, if you love the podcast, the best way to support the podcast is to give us a nice little review on iTunes. If you're watching on it on YouTube or Twitter, like and share as well. And with that said, I hope everybody has a wonderful, wonderful rest of the week. And if you need anything from us, you can hit us up at our sponsor, Tackle Trading, at team@tackletrading.com. And if you're looking for an amazing trading community to of like-minded investors all helping each other navigate the financial world together. Head over to tackletrading.com as well. Guy, thank you so much. Appreciate you, my friend.
Matt.
Everybody, have a wonderful, wonderful rest of your day.
Thank you.